Welcome back to the Osborne Books Bookkeeping Controls tutorial, chapter number 5, the journal. We've just got this and chapter number 6 left to do. So I'm going to do the journal today with you, or what's described as a journal. So first of all, I'm going to clear up a bit of confusion that you will have when you see chapter 79, or page 79 and page 80 next to each other. So we have something called the journal, which is a book of prime entry. And we also have something called the journal, as some entries in the general ledger. And that's the journal and the journal. Is they the same thing? No, they're not. It's the same name used for two different things. So, journals, all entries into the general ledger are done via journals from books of prime entry. So all of your sales daybook and your purchase daybook and your discounts allowed daybook and your cash book from the books of prime entry are all posted into the general ledger via journals. But what happens if we have a transaction that we need to get into our general ledger that we don't have another book of prime entry, another for our typical transactions? So what happens for our atypical transactions, our unusual ones? How do we get them into the general ledger? And we use this last book of prime entry, which is called the journal. So it's a special book for non-typical transactions in there, and it's given this sort of special level of position, a chapter all of its own, because of its importance. So it's transactions within this book of prime entry that aren't covered by the other books of prime entry. Why are they important? Well, because all the other books of prime entry, people would have specialised in them. So the sales invoice person posts to the sales daybook, the purchase invoice person posts to the purchase daybook, and that's all that they do often. And the person who runs the cash book does the cash book, and that's what they do. This journal is a whole series of different transactions as we're going through. So they're not typical, and so they often require, and they mainly require a higher level of accountancy knowledge to get the answer right. So that's why they hold a special level of importance. As a consequence, it needs to be controlled, because if everybody was posting journals and everybody had access to this book and was putting in whatever they felt like, our accounts would soon get a mess, and they would be a total mess, and our balance sheet wouldn't balance and things wouldn't make sense. So it's going to be controlled from an accuracy point of view. Only a couple of people are going to be allowed to post into the journal book. Secondly, if everybody was allowed to post into the journal book, they could use it to hide and siphon off funds. So let's say somebody like our debtors clerk could tell a customer to pay into a different bank account that was theirs. Then they could make a journal in the journal to write off the debt, and as a consequence, they kept the money. So our balance sheet would balance. We wouldn't find it if they had access to the journal. We might eventually find it if we looked at through our write-off amounts. But it's possible then, if everybody had access to the journal and to posting non-typical journals, that they could use it to commit fraud. So there's going to be a level of control over the journal. Within a manual system, it's the book, whoever holds that particular book of prime entry. In an electronic system, it will be the password protection. That certain people will typically only be allowed to post within their own various section, and only a couple of people will be allowed to post non-typical transactions as journals. So that's the journal. It's a book of prime entry, and then there are journals which are posting to the general ledger. Okay, that gets us to page number 80, and we're now going to produce journals. Now, before I start producing journals with you, I'm going to have to make a correction to the bookkeeping transaction books in chapter 3. I think it's on page 57. If you have a look, it's described, and what you will have had described to you as the accounting equation is assets minus liabilities equals equity. So the bookkeeping transactions book describes the accounting equation as assets minus liabilities equals equity. That is not the accounting equation. That is the position of financial statements. It's the balance sheet. It's not. So it's not the accounting equation. feel free to Google it. If any of you can find a link providing this as the accounting equation, let's say in the first 50 examples that come up, post it. For us, I'd be glad to see it. You probably won't find it in the first 1,000, and you wouldn't have found it for the last 1,000 years either, as long as the accounting equation has been in existence, because this isn't the accounting equation. So you may as well take a line and draw it through your chapter 3 of the Bookkeeping Transaction book. What is the accounting equation? The accounting equation is assets equals liabilities plus equity, debits equals credits. That's the accounting equation, and that's what you will see in every example when you test this and Google who is right. The accounting equation is assets equals liabilities plus equity, debits equals credits. Now, am I just being picky because they add up to the same thing? Well, this is algebra. It's not accountancy. This is accountancy, and I'll explain, and it'll become relevant when we get to start to produce journals. How we have all of our debits on one side and all of our credits on the other side of a journal, and also as well within our general ledger accounts, and how we do not have minus debits. So we do not have minus things on one side of the equation. So, and a liability is not a minus debit. A liability is a credit. So it's a positive credit. Everything is always positive debits or positive credits. At the end of a control account for the month, and we want to see what the carried forward position is and the brought forward position is for the following month, then we deduct off our credits from our debits or our debits from our credits to work out what the carried forward position is. But that is only to produce the next month's opening position. It is never to produce a journal. Now this is important because it's going to make it a lot easier for you to understand how to produce a journal if we use this version, or this, the correct version of the accounting equation, or simply we use the accounting equation. How are we going to create a journal? So we're going to do this in these steps here. So first of all, we're going to decide if something is a debit or a credit, and how to do that is I've given you a 5-step method here. And you can stop at the point that you've worked it out. Is the item in question an asset or a liability? So a note as well, equity is a liability to shareholders. So equity is a liability, it's not an asset. It's something that the shareholders want a return from. They either want it back or they want a dividend on that shareholding. They have a return, so it's a liability to the company. So first of all, you decide whether the item in question is an asset or a liability. If the asset is increasing, it's a debit. If the asset is decreasing, it's a credit. If the liability is increasing, it's a credit. If the liability is decreasing, it is a debit. I'll give you a little chart of this later in the next slide. That's the first thing you're going to do. Now what I'd like you to do is I'd like you to look at page 80, and I'd like you to look at the top journal there. And what you will see is that bank and capital, a debit and a credit here. So let's have a look. Let's just do this as well. Bank. Right. So this is something where we paid in £20,000 worth into our bank account, and we've got £20,000 worth of shareholding. So is the bank? Well, the bank is 20,000. It's an asset, isn't it? So it's an asset. It's £20,000 going into the bank account, so it's increasing. So that would be a debit. Capital. Well, that's equity. So that's amounts that we owe the shareholders. So it would be a liability. Is it increasing? Well, yes, it's increasing. So that would be a credit. So that's worked out our debits and our credits to start with. Now I think that we didn't used to do when we produced this manually, we didn't lay it out like this in terms of this bank and capital next to one another in a straight line. You don't. You indent your credits further off to the right. So you would slide them across, and what I'm going to show you, there's a journal there. You'll see how the debit has been put here, the credit has been slid off slightly to the right. I'll take you through this one in detail in a minute, but now that's been moved over rightwards. Why? Well, the reason why is because at the end of your journal you need to make sure it adds up. So once we put in our amounts in point 3, and then we add up and we check that they equal one another, so that our debits equal our credits in our journal. What happens if they don't add up? Well, when we go back and we check it, and if we've indented, we will quickly see, and you will see much faster, oh yeah, that wasn't a credit, that was a debit. and it will make it much easier for you to correct your mistakes. So that's when we used to do this manually and write them out. You would indent your credits and you would slide them over to the right. Then at the bottom of your journal, you put the explanation, and the reason why is because, remember, this is in a special book of journals, and you want to be able to explain what it was that you were doing that somebody else is coming back and checking. So let's say the finance director is now coming along and checking what's going on here. From a potential fraud point of view, wants to see that you are not writing off bad debts to just be able to transfer the money into your account, and will want to see the explanation sitting underneath. So that's why, although it seems a bit odd, why are we spending extra time putting in this narrative? Because it does take time. It did used to take time to write it out. It had to be put in because somebody would want to check what was going on. So that's how we would produce a journal. Those are the steps. This is the little chart that I'm talking about, and this is the reason why the accounting equation is set out as it is, with assets on the one hand, liabilities plus equity on the other. And this is because an increasing asset is a debit, a decreasing asset is a credit, an increasing liability is a credit, a decreasing liability is a debit. And that nicely splits up, and it's just a much better method of doing it. Okay, so we're going to create some journals. Now, in the last chapter, I presented this as a journal here. I'm going to explain this in a little bit more detail in here. These have some quite significance, these lines. It's what's known as 8-column. So in a piece of paper, on a A4 piece of paper, there would be 8 lines that would go down it. They would typically look a bit like that, a bit like this. This might be a little bit more indented off, but that's how it would look. Yeah. And the four on the right would be about the debits and the credits, and they would have pounds and pence. That was how it used to be, was laid out there. I don't know if it were in America, it would be dollars and cents and what have you, but that's how it would be laid out there. We'd have then 4 columns to the left, and it depended how you felt like laying it out, really. In the journal, which is in the book, the date's been put here. I'd put it there. It doesn't matter. And going forward, I'll use the book's version. But dates in there. Then we got the descriptions. Now, the indenting is where the book's wrong. Then you would be well advised to indent here. Now, I don't know whether you can do it electronically within the exam, but if you're writing your notes out and you're preparing for the exam and you want to make life a lot less stressful for yourself, indent your credits, move them over to move the description to the right. It makes it much easier for you to check your answer when you come back. You'll have some kind of narrative. Now, it's put at the bottom here. I put it at the top there. Doesn't really matter. This extra reference column, this column's been put in. Now you'll see in page 80. I've got something called CB and GL being put in there as a reference, and what that is it's trying to say what the reference is of where this item is going. The capital is going to the general ledger in the capital account. The bank is going to the cash book. Now what that is the use, and I'll take you through a bit more of this later on. That's the use of the bank as an integrated system where the cash book is part of the general ledger. It's not just a book of prime entry. Not typically used. Really, that method. You would typically have the bank as a general ledger account, as its own control account within the general ledger, and you'd use your cash book as a book of prime entry by itself. You'll actually see in chapter 6 they use control accounts to extract the trial balance, and they'd go for a non-integrated system. But for some reason in here we've decided we're going to use an integrated system, which nobody used. So we've got this reference column in here. What it actually is missing is the reference, which is the journal number, because that would be what would be in the general ledger as the note next to it. So they would have journal number 1 as the description within the T account. It wouldn't just, as it's sort of seen on page 81, have just a date. There would be a reference there of what the journal number would be. Anyway, we digress. So the chapter sort of starts off and produces what are the journals, how do we create a journal for an opening capital amount. What I'm going to do instead is go to question 5.4 on page 95. And let's do Lucy Wallace's opening of her business in there as a question together. So, 1st of May, in there we put the date in. Okay, now we've just got the items here. Now, the reason why I like the indentation, which is going to save you a lot of hassle, is we decide now on our items whether these things are an asset or a liability. So, a vehicle, what is it? It's an asset. Yes. Is it increasing? Well, yeah, we've just got a new vehicle. So that would be an increasing asset, which was a debit. Put it far left. Fixtures and fittings, what are they? Well, they're an asset. Are they increasing? Yes, we've got some more fixtures and fittings, so that's a debit, far left. Inventory, right, so that's some stock, which is an asset. Is it increasing? Yes, we've just got it, so it's a debit, far left. Bank account, well, is it an asset? Yeah, bank account's an asset. Is it increasing? Yeah, we've just got £150, far left. There's a credit. Right, now, loan from husband, is that a liability? Yep, it's a liability. Is it increasing? Yep, we've just got this loan. So that's increasing liability, so that's a credit. Shift it over to the right. Now the figure that's left that we're going to put in, which is the capital, well, that's the thing that we own to the shareholders. It's increasing, so it's a credit. Indent it in. That makes it here a lot easier to go back to check your work. Because if you'd slid that over to the left in there, and put that as a debit, let's say, or you decided for some reason, well, if you decided that equity is good, therefore it must be an asset, therefore it's increasing and it's a debit, and you'd put that there, you'd sort of quickly then sit and you'd put it here as well. You'd click, so no, that doesn't work, that's the one, that amount, that goes over to the right. It makes it way easier to go back and check your individual items and go, tick, 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 yeah, that's right, those are right. Oh no, I got the capital wrong. It will save you a lot of hassle. I've put these in here and I've used the integrated cash book system. What I basically said here is that the cash book is part of the general ledger. The cash book itself is the account in the general ledger, and I followed how it's being done in this chapter. In reality, I'd GL it. I'd be using a general ledger account within the cash. I'd use a control account within the general ledger, and the reason why, when we get later on, and we'll see in the next chapter, is because it makes it much easier to extract the trial balance, because we only have one set of information in the general ledger. The general ledger, almost known as the nominal ledger as well, and we only have one set of information to look at and check whether it balances. So I've put it in here as in what's in the book. In reality, I'd put it into the control account in the general ledger. But you need to know both methods if the AAT decides to put that in your exam. Right, I put the figures in here, and then I check the totals. Do they add up? I put a little description down the bottom. That is the creation of my journal, and that, as a 5-step method, just means that you can produce journals more methodically, really. I am seeing in students difficulty to produce journals, and I think it's because I'm now picking up students that have got this as the method of the accounting equation, and it's just not. It's not the accounting equation at all. That is the accounting equation. I'm intrigued now whether anybody can find an example where the Osborne book approach is provided. Good luck, though. I don't think we'll find it. Right, so we've done that, and I've used the accounting system. Now I'm going to use another example then we've got here, which is on the bottom of page 81. So we start a business, and we start a business with £100 cash. So is it an asset? Yes. Is it increasing? Yes. So it's a debit. Put it there. £100 goes in there. The next thing is bank. Well, is it an asset? Yes, it's an asset. Is it increasing? Yeah, it's £5,000 worth of cash. So it's a debit. Tink it into the far left hand side. Put the £5,000 as a debit. We got some inventory, so we got some stock in there. Is it an asset? Yes, it is. Is it increasing? Yeah, we've got £1,000 more of it. Far left, £1,000 in there. We've got some machinery. Is that an asset? Yeah, machinery is an asset. Is it increasing? Yeah, it's a new machine. Thank you very much. Far left, £2,500 in the debit. Trade payables. So we owe somebody £7,850 in there. Is that a liability? Yes. Is it increasing? Yeah, it's just something we've just got. So that's a credit. Indent it. We've also then got the remainder, which will be the capital. yeah, that we've had injected. That's our liability to our shareholders. So is it a liability? Yes. Is it increasing? Yes. Is it credit? Indent it there. Put that in as the figure, which would be the difference between those and those there, and make sure that bottom thing adds up. Put the little description in there. I put it down as opening journal entry. It's been put down as assets and liabilities at the start of the business. And that is that. I put this integrated cash book system in here. In reality, I'd be using control accounts within the general ledger, and they'd all be GL. I wouldn't really have this reference. We also as well would have had a number for this journal. That would be the number that I'd be then using in the general ledger. Hopefully then, that has explained a method of creating journals, and just follow that 5-step method and doing it again and again and again. You cannot go wrong with this method in creating your journals. You will go wrong using this method because it's added an extra step and a bit of calculation that's going on. For some reason, I think some people will start to do minus debits as liabilities. It's just not a good plan. It's not a good look at all, really. Right. Now we have irrecoverable debts written off. I've done that in the previous chapter as well. But let's go through that one and just use our 5-step method to produce our budget. So, is a debt that's owing to us an asset? Yes. Is the write-off of it? What's happening there? Well, it's a reducing asset, so it's a credit. Right. So that would be the credit side of our sales ledger control account. So our asset has gone down. What's the other side? What's the debit? Well, if there was VAT on the amount, then that would be against the amount that we owe the inland revenue, so we could get the VAT back that we paid over. If or the remainder, if there is VAT, the remainder would be a cost to our profit and loss account. At level 2, I think it will go into the well, it says debit the irrecoverable debts account, which would be in the profit and loss account. That would be, I think, at level 3, where you have the profit and loss account and you're doing a statement of accounts, a statement of performance, really, which is a profit and loss account. I think at this level it goes into the equity account, which is basically the shareholders gain all the profits or all the losses of the business. So this would be a loss of money, so the shareholders would cop that. So it's debit the irrecoverable debts account. In there, it's credit. Now it says credit the sales ledger control account and credit the subsidiary account of the customer in the sales ledger. This would be interesting actually, and then we might need to go back to AAT over that one. That's not how it would be done in practice. In practice, it would be credit the provisions for bad debts account and the sales ledger control account, and the sales ledger would not be touched. They would. Because you'd always want to be going back and checking that particular sort of customer, and you'd always want to be chasing that debt, even from the administrator. Anyway, unless you had a massive clear out 5 years down the line or what have you. Right. So I'm going to use payroll accounts now. Now we've got this thing on page 85 about the payroll transactions, and so to making up a payroll transaction, we've got the amount, the gross paid that we want, the total cost to the business, what's going to be actually put in the wages expense line of our profit and loss account. But then we got within that the amount that we're going to pay our employees, and they're not going to get all of that money because Inland Revenue and Customs are going to come along and take some of that money off those staff members, and they want to be paid it in tax. So you've got that, and also that person might say, well, actually, please make some deductions from my salary to pay for trade union fees, and also as well, they might want us to pay into a pension scheme for them. So we've got this pay figure going on. We might actually also have our employers' contributions to a pension scheme as well. You would have those as well now within them, but I'll follow the book. Oh no, they have got pension employers, contributions provided by an employer as well. So what we've got then is we're putting in these figures, this total amount, into a wages control account, a gross figure, a gross pay into there, and then from going forward, we are then in a series of steps taking out from this wages control account various amounts, and we're posting them into other accounts. And this seems a little bit odd. You're thinking, well, why don't we just post them all at one time and forget about this control account and just make the full journal? We're sort of messing about here a bit, really, and it's not required. So why is this control account appearing, especially for a payroll figure? And the reason why is because pay is a very high risk item. So it's complicated to calculate. So it could be done wrong. The significant issues if it's paid incorrectly. So let's say we pay our staff members the incorrect amount, and they got their mortgage that's going out, and they can't pay their mortgage because we got their figure wrong. It's quite a significant issue there, really, if we paid it incorrectly. And of course, there's the potential for fraud. The person who's preparing the payroll might decide that it would be quite nice if they were paid a lot more this month than they should be paid. So we need to sort of work out a method of doing this that prevents some of these issues. So what we do is we have a significant degree, and I've discussed this previously, of the idea of segregation of duties. We're going to split this job up, and we have a number of people performing various parts of the task. So what we're going to have then is a series of steps. So step one is the person who performs the total amount. They're going to do the calculations, and they're going to post that all into our control account. So on page 89, step one, somebody calculates the wages expense figure. So they've done all the calculations, and they put it into the wages control account. They do that, and they provided all the calculations as well. That's their first step. Now, in reality then, step two is the person who does the cash book is somebody who's different from person number one, goes and does the calculations and prepares the BACS return, which is what they're going to pay the people. Okay, so in order for person number two to decide to pay themselves a lot more money, person number one would have had to agree to put a lot more into the wages control account than they should be, in order that person number two could take it out and pay it themselves. So the person who does the cash book is now preparing the BACS payment account, and they're paying all the various people what they think they should have. Probably at the same time, they have a separate list of what the people should be paid as well. So it might have been probably the HR department who's in person number one, who's prepared what should be having. Person number two, who's the person who does the cash book, probably also has a separate set of calculations of what they think the person should be paid as well. So person number two prepares pays all the individuals from the bank account. Now I split this up into the people, but the other 3, 4, and 5 could still be this cash book person. But person number 3 might prepare the return to HM Customs and Revenue, and they're sort of preparing that return, and they do a deduction from the wages control account. Person number 4 does a transfer to the pension fund. Person number 5 does a transfer to the trade union account. And if at the end of that all of the wages control account balances to 0, you know that on the one hand it's correct and everybody's been paid the right amount, and you know on the other hand there's been sufficient segregation of duties between everybody that nobody could really work out a method to siphon off funds into their own account, into their own bank account, either by, I don't know, transferring off the trade union fees into their bank account, or transferring off bits of the pension fund into their bank account, or trying to work out how to steal from HM Revenue and Customs. It can't happen. So that's the plan. Now, when it can happen is if the wages control account isn't balanced, and then or isn't reconciled, so we don't check that it equals 0 at the end of it. And so that's how that would work through. We then even if we decide to split it into separate people, we've got a set of series of different control accounts that the person number 2 who does the payments comes along and makes the payments and clears them out. So that is chapter 5. I've gone through then how to create journals. I've corrected the accounting equation, and we've just gone and done the wages control account as well. Let's do some questions then, shall we? So, Hussein Limited is a furniture manufacturer. Which of the following transactions will be recorded in the journal? So it's something that's not in one of the main prime books of entry. So, sale of furniture on credit to a customer. That's going to be in the sales day book. Cash purchase of fabric for a chair or seat covers. Well, that's in the cash book. Write-off of trade receivables accounts from a sales ledger as an irrecoverable debt. That's going to be in the journal. Petty cash purchase of postage stamps. Well, that will be probably well, it'll be in the cash book as it's described within the books here in bookkeeping transactions. So, sorry, I'm just going to just check always a bit of pressure to see whether I got that right. Yes, I did. Well done. Right. Which one of the following will not be recorded in the journal? Tick the correct options. Payroll transactions, cash sale of goods. Well, that won't be in there. Write-off of so cash sale of goods, that will be in the cash book, so that won't be in there. Payroll transactions, yeah, that'll be in the journal because it's not got a day book attached to it. Cash sale of goods, that'll be in the cash book. Write-off of recoverable debt, that'll be in the journal. Opening entries, that'll be in the journal. So the answer is B. Yay. Keep congratulating myself on this. I should really do better. Which financial transaction goes with which book of prime entry? I'll let you do that one. There's quite a lot going through. 5.4. I've already given that as an example within the figures. Jane Seymour was setting up a new business and listed all the accounts and the amounts that she's used. She asked you to create a journal entry by ticking the appropriate column in the table below and to calculate her opening capital. What I'm going to do is, when we're doing this, have the book open. Let's go to this chart here. Cash. It's an asset, it's increasing, it's a debit. Cash at bank, it's an asset, it's increasing, it's a debit. Capital, it's a liability, it's increasing, it's a credit. Trade payables, it's a liability, it's increasing, it's a credit. Trade receivables, it's an asset, it's increasing, it's a debit. Loan from the bank, it's a liability, it's increasing, it's a credit. Office equipment, it's an asset, it's increasing, it's a debit. Rent paid, it's a asset. Oh, sorry, now, hang on a second. Rent paid, it's a liability. So it's a liability to the shareholders, but it's reducing their liability to the shareholders. It's a debit. Okay, so that's an interesting one there. That what we're seeing is that it's an expense. The shareholders get the profit of the business, so they would get the sales sales would increase the liability. In here it's an expense, so it's a loss effectively to them. It's increasing. It will therefore be reducing the liability, so it will be a debit. Inventory, that would be an asset, so that would be, and that's increasing, so it would be a debit. Sundry expenses, that's a reduction then in equity, so it's a reduction in the liability, it's a debit. Vehicles, that's an asset, it's increasing, it's a credit, it's a debit, sorry. Wages, that again is a reduction in the equity, it's a reducing liability, therefore it will be a debit. Let's just tick those off. Yay. Thank goodness for that. Right, I think that's enough really for today. Carry on with the rest of the questions and good luck. Thank you for listening.